With Peter Switzer, the founder of the Switzer Report, for his Monday morning appearance here on First Edition. Good to see you, Pete. Thanks for your company this morning. So just how significant is that downgrade when it comes to commodities and when it comes to company tax receipts? I mean, it's multiple billions of dollars there. How much is actually in Jim Chalmers' control?
Probably very little, because one of the big benefits of a strong China has been high commodity prices, particularly iron ore. And that's been a windfall gain for a number of treasurers. Going back to even Josh Frydenberg, he often talked about the surprising high price of iron ore compared to the budget estimate around $54 a tonne. Now, so that's one part that Treasurer Chalmers can't control. The other part is what it's spending, and we know public sector spending is massive at the moment. But it's not just the federal government, it's also state governments. And everywhere we go, Pete, we see all these massive projects which have nearly all have had blowouts in the overall spending, particularly in Victoria. So and then of course throwing the fact that we got tax cuts as well. All those have contributed to a deficit. And we also know the Australian economy is growing slowly. And when that happens, the government gets less tax collections and they have to spend more on unemployment relief. But right now, an unusual economy is actually showing there's less money on unemployment, and that's really weird. I think that will change pretty soon.
So when that feeds into the story about potential rate cuts, I mean, the consensus was that it was a lock for early next year, that it was going to be February. Then we got the jobs figures last week, and all of a sudden, whoa, it's not going to be so soon. It could be mid to late next year. Where are you on that?
Yeah, well, so if you think about Pete, it was May, it was February, then when the inflation numbers came in, it became May. Then the national accounts economic growth number was hopeless, so we went to February, and then last week unemployment fell, and then went back to May. I found it really interesting, Pete. Shane Oliver's looked at the things that are going on that are being ignored, like, for example, the economy is weaker. There's ongoing per capita recession. There's a strong November jobs data, which really a lot of people say, how the hell did that happen? If the economy is growing so slowly, 0.8% for the year, 0.3% for the September quarter, how does unemployment fall? So I reckon those numbers could end up being proved dodgy. And despite the low unemployment rate, wages growth is slowing. That's another thing that Oliver threw into his analysis. And finally, we are now in the December quarter, and it's highly likely the December quarter is slower than the September quarter. So we might get a surprise number, but we won't see that till after the meeting. So therefore, we're stuck with two pretty important things: inflation and unemployment, and we'll get them in January. And that is the only way we can see February being a rate cut. They'll have to be numbers.
This rate cut debate, it's like, you know, looking at the crowd at the tennis when the faces move from one court to the other as this argument continues. So anyway, like you said there, we'll wait to see how that plays out. What about the US? Will it get another rate cut, Pete?
Yeah, big question this week, because they've started to see some pretty strong numbers for jobs and also inflation a little bit higher than expected. The Yanks will make a decision of Federal Reserve on Wednesday, and the economic growth will be coming out on Wednesday. But the PCE, that's the Fed's favourite inflation measure, that comes out after the interest rate decision. And so it's really a 50-50 thing. I think the Trump pressure will be on the Federal Reserve. They'll probably cut, and that will mean that if the PCE comes in bigger than expected, the Yanks can forget about a rate cut for quite some time.
Okay. All right. Good to see you, Pete.